Get to our closing bell exchange. Joining us here is Art Cashin, Director of Floor Operations for UBS, and Ralph Acampora, Director of Technical Research for Altaira Capital Partners, and Rick Santelli is at the CME for us as usual. Thanks to all of you. Art, just mentioned, you could kind of look at any point on the compass and say it's the Fed, it's China, it's even Italy. What do you think was the trigger today? Is this just kind of part of this bottoming process or something worse?
Yeah, no, I think Italy had a great deal to do with it. Just as the European markets were beginning to close, you had a couple of things. Draghi spoke about the risk to the EU and the EU economy if people didn't play by the rules. That was a slap at Italy about having a rather creative budget process. And then a few others in the EU land took a shot at Italy. The yield on their bonds spiked. We were close enough to the close that it didn't have a disproportionate move in Europe, but they started to sell them there. Interestingly, contemporaneous with that, Secretary Mnuchin announced that he would not be going to Saudi Arabia. And I think a lot of people saw that headline and said, oh, that's why the market's selling off. If it had been due to the Mnuchin decision, I believe that oil would have spiked, showing that the relationship between the U.S. and Saudi Arabia was going to become testy. Oil did the opposite. It came down. So I believe it was Italy more than Mnuchin.
And whatever the trigger, just quickly, the fact that the market had kind of absorbed it, it went down toward last week's lows but didn't really threaten them, and now we've lifted a little bit. Does it mean anything?
Yes. I think you're dead right on where we are right now. You went down, you broke the 200-day moving average in at least two key indices. You've also got the transport selling off in a manner that could cause a Dow theory sell signal. So it looked like everything was going to come unraveled, but they didn't. There was no trapdoor sell-off once you broke those levels. So I think you're right. I think people said, okay, tomorrow's an expiration. Maybe I don't want to throw them out the window yet, and the selling dried up a little bit.
So, Ralph, what are you seeing in the charts and the correlations? I mean, Art threw out a number of things, everything from Italian bond yields to Treasury yields, yes, not to mention the 3% drop in China's stock market overnight and the big drop in the currency as well. What does it all mean for U.S. stocks technically?
Well, Art is absolutely right. There's a lot of uncertainty out there. And you even had Larry Kudlow talking today about the Chinese are not willing to talk to the U.S. on a positive basis. I think that's part of it, too. But if I could use the analogy of a beach ball, if you go to a pool and you put a beach ball underwater and you let your hand go, it pops. That's exactly the way the market has been in the last couple of weeks. We are very oversold, and we're getting this pop. But unfortunately, I'm not that impressed with the rally or the recovery. I need to see more stabilization. I'm a little concerned about the failure to make new highs and the failure to hold the rallies. The one thing the market doesn't like is failed rallies.
And Rick, it's funny, the stock market is acting a little melodramatically, arguably, and they're blaming some macro stuff, right? Whether it's Fed minutes, whether you had a hot leading economic indicators number today, maybe the dollar is up a little bit, but none of that seems like it's really out of the recent range. So what's your read on how the other markets are kind of metabolizing all this?
But actually, it is out of the range. This morning, we saw that the 6 trading session really tight yield closes along the curve were looking to bust out. We saw it on an intraday basis yesterday. We closed at 320 in 10s. Today, it looked like it wanted to challenge 323, the high yield close of the year. We're at 337, 338 and 30s. 340s are high yield close of the year. So it was arrested development with respect to the higher rates. Rates want to go higher. They do pay attention to stock volatility. Unlike Europe, they don't bring yields down dramatically. It just stops the upside from developing. And I love Ralph's analogy. I'll take it a step farther. Okay, we know there's a big brouhaha between Brussels and Italy. I get it. And we also know liquidity is starting to drain globally. We've doubled the pace since October 1st on the Eurozone side. Our central bank is doing it. So with Ralph's beach ball analogy, how much does the beach ball pop if it's resting on the bottom because all the water's gone? These things are all pointing towards issues. And listen, don't underestimate the notion of how over-margin and over-collateralized markets like in China may be. So, just like any individual, when the market goes down, you have to pony up. It's a global margin call of sorts as well.